Hi students, so this is part 2 of the video and we stopped at the loan. Okay, number 6. So it says provide for outstanding interest on the loan. The interest on the loan is calculated at 16% per annum. The interest is outstanding for 2 months. So this is what you're going to do, right? Whenever you want to work out interest, you will take the capital amount times the percentage times the month over 12. Okay, so where will you find this capital amount? You'll find it in the trial balance. So what you're going to do is say you're going to look for the loan, mortgage loan, 1,260,000. So we'll say 1,260,000 times, what is this, 16% times 16%. Now usually this will be 12 over 12 when we want to work out the interest for the entire year, but do we want to work out the interest for the entire year? No, because it says clearly that the interest is outstanding for 2 months. 2 months for 2 months, right? It means that the interest has not been paid. So we're going to say 2 over 12. Then we are going to take the calculator, 1,260,000 times 16% times 2 over 12 equals 33,600. Okay, then interest on loan is 168,000, right? So the 33,600 is the amount of interest that we must still pay. Okay, so all we're going to do is we are going to go to our profit and loss account. Here I have the balance of the interest on the loan and I already added it here, 33,600, and I referenced it as note number 2. Oh god, I don't know whether you could see that. Okay, so there's the interest on loan of 33,600 with the note number 2, and then here I will reference note number 2 to show my working. Okay, the next one. So it says depreciation for the year has been correctly calculated as follows: on equipment for 255,000 and on vehicles for 389,500. So it says it is correctly calculated. Now, is there any adjustment for you to do? No. But what I do want to cover at this point is that there are 2 formulas for depreciation. There is the cost, which is equal to the cost of the vehicle or the equipment times the percentage times the month over 12. And then there is the diminishing balance method, DBM, diminishing balance method, which is equal to the cost minus the accumulated depreciation times the percentage times the month over 12. Okay, in the event that you get an adjustment where you have to calculate the depreciation, it's not calculated for you, which is highly likely, please remember these formulas. This is a side note, but because they calculated the depreciation for us already, all we're going to do is add these 2 amounts. Okay, now you will notice that they didn't give you a balance for depreciation, but you will make your own expense here and you will just add the 2 depreciation figures. So we'll say depreciation and then I will add 255 plus 389,500. Okay. The next one, it says provide for outstanding interest on the fixed deposit. Again, the outstanding interest. That means now that interest, some of the interest has already been received. Why am I using the word receive? Because interest on fixed deposit is an interest income. Okay, so here it is here. The interest on the fixed deposit of 25,000, that's what we received. The outstanding amount is 25,000. So we didn't need to work out anything because it already told me that the amount that I still need to receive is 25,000. So I'm going to go to my interest on fixed deposit. I never add that balance at the beginning, which was a big mistake. I should have. It was 25,000. I'm going to say plus 25,000. Okay. The next one, it says insurance has been paid for in advance by 11,000. Now this is a prepaid expense, which I wrote in one of the previous years. Okay. Now, insurance firstly is an expense. And it says it has been paid for in advance. This simply means, for example, that I'm going to receive this insurance in the next financial year, but I have already paid for it in advance. It is a prepaid expense. So what do I want to do? Right, I basically want to get rid of this expense. A side note that a prepaid expense should always be minused. Okay, I basically want to get rid of this insurance because it does not belong within my financial year, and they already gave us the amount. It's 11,000. So I will go to my insurance and I'm gonna say, where's insurance, minus 11,000. Okay, the next one, it says stock on hand as per physical stock count on the 29th of Feb 2024 reveal the following: the trading stock of 534,000 and the stationery of 5,000. Very important adjustment. So listen, let's do the easy part first. When they are saying that this stationery is on hand, they are simply meaning that we bought stationery, we found some stationery in the stock room. Will I use the stationery at the end of the year when my business is closing? No, I won't. I will use it in the following year. So the expenses for this year, I must decrease it because I now have this stationery that I found in my stock room. Okay, so I'm going to go to my stationery. Where is my stationery? Did I record it? Yes, there's it. So I'll say minus, what was this amount? 5,000. This would have been better if I put the amounts at the bottom, but anyway. Okay, and then the next part